2008 was the first year, and that was when we were experiencing the significant recession, and so the government was interested in giving incentives for people to buy homes who had never owned homes before, but they weren't willing to go all in, right? So they said, we'll give you a credit, but we want you to repay it over 15 years. Okay, and then in 2009 they decided, well, you know, if you take the credit and as long as you own the home or use it as your primary residence for the first 3 years, we'll allow you to keep the credit and not have to repay it. If your house ceases to be your primary residence for any reason, then you may owe full repayment of the credit immediately. In addition, if you were to convert your home to rental use, so you started to rent it to people, or you were to, for instance, make it your vacation home, then you would immediately owe back the repayment or need to repay the credit that had not yet been repaid.
Congress passed some provisions to help out victims of Hurricane Sandy, and those jurisdictions are typically in the states of Maryland, Connecticut, Rhode Island, New York, and New Jersey. So if you're a resident of those states, or if you're an Indiana resident who actually has a business that's located there or does a lot of operations there and has records there, or if you own vacation property in any of those jurisdictions, you should check with your tax preparer to see if in fact there are some provisions that will provide you some extensions to filing, and also especially if you're a business and you have a lot of your operations in one of those jurisdictions, you should definitely check with your tax preparer or your CPA.
There is a tax on net investment income, which would be generally the usual suspects: interest income, rentals, dividend income. Once your adjusted gross income exceeds the 250,000, or excuse me, 200,000 single, 250,000 married filing a joint return, then you will be subject to a 3.8% tax, which is the same amount as the Medicare tax on people with income that high. It's just imposed on different income.
You got to work your preparer. You've got to just ask him, and well, what about this? Can I deduct that? Can I do this? And your preparer should be an enabler, not a disabler.